All right, everyone, let's look at this visual representation of a waterfall distribution. This is a critical concept in private investments, and it's a section of the PPM you should always analyze closely. It's called a waterfall because it shows how money flows down and is distributed in a specific tiered order of priority, just like water cascading over rocks. Now, the asset we're talking about here could be a variety of things. The deal sponsor could be using investor capital to develop a piece of land and then sell it, buy an existing apartment building, improve it, and then sell it, or purchase a private company with the goal of selling it a few years later. The principle is the same. You buy or create an asset, and the total proceeds represents the cash you get back when you exit that investment. First, you see the dark green bar on the far left is labeled initial investment. In this deal, that's $3.4 million. This represents the total capital contributed by investors or your clients. It's a starting equity base. Next, the second dark green bar shows total proceeds at sale, which is about $7.3 million. This is the total cash generated when the underlying asset was sold. This is the total pool of money we have to distribute. Now, the important part begins, the waterfall itself. The light green bars show the decreases or the distributions from that total pool of money. The key here is the order of payment. The first hurdle is return of capital. So as you can see, the first distribution is labeled return of capital, and it equals the full $3.4 million initial investment that gets paid back to investors. This is the most critical hurdle in any deal. First and foremost, before any profits are shared, the investors get their original capital back. Once investor capital is returned, we move to the tier called preferred return. In this deal, investors are entitled to an 8% annual non-compounding preferred return on their capital. Based on the 5-year hold period in this example, that amounts to about $1.3 million. This is the second hurdle that must be cleared. So after getting their initial $3.4 million back, investors then received their preferred return, an additional $1.36 million. Only after investors have received both their full capital back and finally, sponsor 20% shows that the sponsor, the manager of the deal, receives their 20% share of the dollars that were remaining. This is $520,000 approximately. This sponsor's share is often called the promote or carried interest. So as a fiduciary, the key takeaway here is understanding the alignment of interests this structure creates. The sponsor only receives their profit participation, their promote, after investors have been made whole on their initial investment and have received a preferred return. When you're reviewing the PPM, this is a section that you must scrutinize. This is a fairly standard example, but they can get much more complex with multiple hurdles. Your job is to understand exactly how and when your clients get paid.